Hey, you guys, how are you doing today? My name is Charese Chambers. I'm the owner and founder of Financial Fancy. And you're probably like, why are you here? Well, let's be clear. I'm here to show you how to optimize your financial management for startups and even if you've been in business for a little while. Because let's be honest, the landscape of finances is always changing, right? I mean, can we say pandemic? Absolutely. So today I want to kind of go over key points of the things that you should be keeping track of that helps you optimize your financials. So what reports are you pulling from your QuickBooks or your HoneyBooks or your whatever bookkeeping software that you're utilizing? And then how do we take those numbers to read better strategies and strategically move in our entrepreneurship journey to optimize how much revenue we're trying to make and how much money at the end of the day we're trying to keep as our bottom line. So, what is a profit and loss report? I know you've heard the term, but what is it actually? A profit and loss report is actually a report of the business revenues, costs, and expenses during a specific period. So, if you're using any kind of software like FreshBooks or QuickBooks or even Wave, you can actually specify the time frame you want to see how much money you made, how much money you spent, and how much it cost. And why is this report so important? It actually summarizes how much money the business made, how much it spent over that specific time. So then you start seeing trends, right? As someone who's a fractional CFO, something that I see a lot of business owners do that's not, is frowned upon amongst the establishment is when you kind of want to either you're a startup and you don't really know what your numbers really are at the moment. So you're guesstimating, and that's okay, right? Because you don't know what you don't know, but you're trying to learn. But if you give me a profit and loss sheet or a projection report, right, and you say that every month you're going to make $5,000, that's not realistic. We're really looking for real time numbers. Your numbers are actually telling you the flow of your cash flow. So not only is your profit and loss sheet telling you how much money you made, how much money you spent, and how much money you're keeping or losing, it's also telling you the cash flow as it comes in and out of the business. So it's very important when you're making decisions in the business. So let's take an industry for example, because of course I like to do case studies so you get a real life situation. So let's say you're an ice cream shop. Well, by the time you guys are watching this, it should be August. So that means we're in the heat of the summertime, right? You're probably selling hand over fist ice creams, right? But if you're starting out in a business and you want to start opening up an ice cream shop in December, you're probably not going to be making $5,000 a month, right? It's not during the high peak of when typically people want ice cream, nor is, depending on where you're at as well, if there's going to be enough foot traffic to bring in people to buy from the business. So now you can kind of see why it's important to understand the cash flow of your business through your profit and loss. Some components of your P&L, if you've ever pulled it, is at the very top, it tells you your revenue, but not just your revenue, the different types of revenue that you bring in, which kind of takes into something we want to talk about is categorizing your items specifically. So making sure when you open up your QuickBooks or your Wave or your FreshBooks, right, that you're customizing your chart of accounts so that when you categorize things, you actually can pinpoint where the revenue or the income is coming in, very much like your expenses, right? So let's take an artist, for example. I had a client where we customized their chart of accounts when I first took them on, and I realized that they displayed some of their artwork at a gallery. The gallery did a commission base. So the gallery actually kept 30% of the income that was made off of the sale, and they gave 70% to the artist. So instead of us, let's say the artwork was $100, instead of saying that they made a revenue sale of $70 because of the cut, right? We actually went back and said that they made $100 and then the expense was the commission that they had to pay for their artwork to be at the gallery. So you see sometimes when you're breaking down your numbers why it's important to know that, because now when we do the revenue sales, right, we're doing commission based revenue, maybe direct to consumer revenue. So there's like selling artwork at a gallery or a pop-up shop or something like that. And now we can really assess like what the return on investment is with the expenses that occur with the revenue. So you see how now your numbers aren't just numbers of money, but your numbers are also numbers of strategy, right? I think a lot of entrepreneurs, what happens is that they are not necessarily not critically thinking, but the thought process is you're not giving enough thought process of the return on investment part. What you hear is that this costs money, and really the thought process is, but what's the return on this thing? So if I start looking at the client's profit and loss sheet and saw that they made $10,000 on commission revenue, so the commission revenue is a trigger to me saying, oh, these are sales that they made from artwork that was placed throughout different galleries in different areas, right? But they're only making $1,000 when they do pop-up shops. Then the thought process is that they're making more money in the art gallery, and although they're not losing, they're actually having to pay, because that's the main pain point for most entrepreneurs. They're like, oh, I don't want to pay this expense. But when you look at your numbers, if you're making more money from it, it also means, and what I would assess the numbers is telling me is that you're getting more exposure, because now you're not just relying also on your own individual labor doing pop-up shops of your own, but now your artwork is in places that you can't even be present in. And sometimes that is the biggest return on investment. So I want to give you guys some empowerment to feel empowered to have critical thinking, and then not just consider the expense, but more so have a different perspective of considering the return on investment and as you're making different decisions for your business. Another component of the profit and loss report is cost of goods sold. And I think it kind of gets a bad rap, or it's kind of miscategorized in the profit and loss area, as far as I'm concerned, as a bookkeeper, right? Is that the cost of goods sold is exactly what it means. It is the cost of how much it takes for you to get to the inventory of the item at a sold finished product, right? So cost of goods sold should be utilized for people who are buying different ingredients or items to make a complete product. So I'm thinking of bakers, right? Your cost of goods sold would be the flour, the sugar, the milk, the eggs, right? To make a cupcake. The cupcake is the finished product, right? But if you're providing a service, you're not doing cost of goods because it's already a built-in thing. It is the finished product as you give. So remember, if you make sure that you're utilizing the categories correctly so that your profit and loss report is giving you accurate feedback and numbers so that you can make more definitive decisions in your business. The last thing is also expenses. These are actually deductions for your business. And I want to take a little caveat here for a moment, because I know that you guys probably have heard the phrase commingling funds. The reason why a lot of us bookkeepers stress over and over and over again for you guys to separate your funds and your business expenses is because you won't be able to decipher how much money the business is actually making and spending if your money is commingled with your personal expenses. So that's why it's so important to be able to have them separate so that you can actually make strategic moves in your business as you make those decisions. And then lastly, after we take all of the money and all of the expenses and all the costs for you to make your product, we either have a profit or we have a loss. So at that point, we can see how much money the business is making. And let's be clear, I think a lot of us our businesses are close to our hearts, right? But ultimately, the business is an entity of itself, and we want to make sure that she can stand, or he can stand on its own 2 feet as you're doing your business. So I kind of already went over how to read the profit and loss sheet, but it's really important for you to understand this so that you can make sound decisions, right? Your profit and loss is almost the do or die of the financial health of your business. It identifies the cash flow, how much money you're making in different revenue streams, and actually how much money you're spending. And at the end of the last quarter of each year for all of my clients, what I do is we do a tax planning session where we kind of look back on what happened in the year prior and we look forward to anticipation of what will happen ahead of time. I have a client, she hit her 6 figures last year, but I was able to predict that because she had been in business and I've been doing her bookkeeping for the last 4 years, that she was increasing her revenues somewhere between 25 and 35% year after year. And so after reading over her numbers, we were able to actually project a year ahead of time that when she was going to hit her six-figure mark. That's why it's important to know your numbers, right? You can actually legit see the makeup of it, or the vice versa. I had a client right before the pandemic happened. We were already talking about moving the business to an online presence to increase sales. But I noticed in the first quarter, she was a retail store, that her numbers are kind of dwindling a little bit more drastically than they normally do. Because remember, you're not making consistent money like this. Retail stores typically take a dip in Q1 because it's after the holiday season and people are done buying Christmas items. I mean, let's be honest, right? So, of course, the numbers were dipping. But there was something else that was happening in her profit and loss sheet month after month that kind of was taking me aback, right? So it's making the assessment, looking over the numbers, and gratefully, March, and if we go back, March of 2020, that was when we all shut down. And I was so happy that not only was she able to maintain the revenue that she was making because she had an online presence now where everybody was sitting at home on their phones, and able to keep her doors open, but she also was able to maintain her income to come in for a business and break even at least, in a time where a lot of restaurant businesses and even restaurants and things of that nature were closing the doors and are still closing the doors even to today because they haven't been able to recoup from the pandemic from what happened. So I want to give you an example of a P&L. The numbers are kind of small, but kind of going through what we've already exampled. So you can see with this particular business, it has a product line, a service line, and some other income, right? So let's think about even your business. A lot of times businesses think that they only have one revenue stream, and they actually have multiple revenue streams. I always encourage entrepreneurs to not feel stuck or feel like they need to be a jack of all trades, when really you could hone in on the one thing and it does multiple things. So for this particular example, I'll be the example here. So Financial Fancy does bookkeeping, taxes. She has a podcast. I have journals on Amazon. I do speaking engagements. So you can see easily Financial Fancy is just not one space, but she's all the spaces, right? So I want you to also to do the same example. What other different revenue streams do you have in your business? And you're probably like, well, Charese, I just sell the cupcakes. Well, different forms of revenue could be the revenue split up with how much money you make at the pop-up shops. How much do you make at your own brick and mortar? How many wholesale accounts do you have, right? So again, I want us to all pause. Maybe you're thinking a little bit too small, and I want you to think big and project those things, right? Because now you can actually get an accurate reading of what's making money and what's not. Again, remember, we're worried about our ROI at the end of the day. Of course, as you look through the profit and loss report, we see all the other expenses. And what's really important is that bottom line. Is the business making enough money to sustain itself? Remember, just a little bit ways back, I had mentioned that at the end of the month, we look over the P&L. Well, another reason why we do that is because a lot of the times we miss things or we're spending too much money. Obviously, inflation is a real thing, right? Especially for my baker clients. Eggs have gone up, milk has gone up, all the things that it takes for them to serve cupcakes and the cakes and the delights. But the other thought process is that as inflation is going up, maybe we're spending money on things that we don't need. One of the things that I actually did in my business was, how do I consolidate some of the things that I utilize? And at the end of this presentation, I'm going to give you all of my favorite apps that I absolutely love. When I first started my business, I had Mile IQ. I was also using Receipts, a Receipts app, and then I had QuickBooks, and I had a contract app, and I was like, man, there's got to be a better way for me to do all of these things. And of course, QuickBooks, as I did more digging, was like, oh, QuickBooks actually can keep track of my mileage. So I was able to get rid of Mile IQ. And then I started using HoneyBooks almost about 2 years ago. And HoneyBooks actually is a POS system. You can do contracts in it. You can do scheduling in it. There's a multitude of things you can do it. So now I have two apps, and HoneyBooks and QuickBooks actually integrate with one another. So they date real bad. And I love that for me because now I end up saving $250 on all these other apps that I was utilizing and just using two apps in my business. And I really love that for me. So maybe a thought process too, as we're creating critical thinking, as we're looking at our profit and loss reports, what things are we actually not using, or how can we consolidate them in other apps where we can maximize what we're doing in our business? So, in addition to our profit and loss sheet, I'm going to go over some of the balance sheet basics because that's another report that you should be very familiar with. And you're like, Charese, what's a balance sheet? Because I know that most people are not very familiar with it, but it is something that you're going to need to know, especially if you're asking for lending opportunities from banks. So, a balance sheet basically is a list of all your assets, your liabilities, and then your owner's equity or your shareholders' equity. So the equation looks like this: assets equal liability plus owner's equity. And a lot of clients, what I find is your assets are like all of your accounts receivable. So we're talking about people who owe you money, right? So maybe you do a net 30, net 60, net 90, or you do government contracting. That's money that people are owing you. But on the flip side of that, on the liability side, is going to be loans, PPP money you might owe back, or people who you owe money to. And then, of course, any shareholder monies. And the balance sheet is actually a snapshot of a time frame of how much the business is worth. And that's key because if you've given some thought to what an exit strategy is, this is going to be key. I've done a couple acquisitions in my life, and I've actually had a client who wanted to buy a business, and the business owner at the time had been in the business for 30 years. Love that for him. But he wanted to sell the business for $2.8 million. And so, of course, in our due diligence, we asked for all the recent profit and loss sheets because we need to know how much money this business was making and how much money the business was spending. And come to find out, the business was losing money roughly for about the last 6-7 years. Now, of course, I give grace because of those years that we got the reports for was the pandemic. So got it. We give grace, right? But even before the pandemic happened, the business was not profitable. Okay, not a big deal because again, it's just a snapshot and the business had been going on for the last 30 years. But when we pull that balance sheet, it told a whole nother story. The owner had not replaced any of the assets, which were the equipment to do the job that the business had to do without disclosing what the business is. So when you think about it, now the person who's buying the business, realizing that the person hadn't been replacing any of the equipment since they opened, what the liability now on them was in order to continue to do the business, they were going to have to replace a lot of the equipment. And now we're talking about a couple hundreds of thousands of dollars. So that was taken into account at the end of the day when the business was sold. Now I know a lot of us are like, especially, listen, I've been in business for 18 years. We've put sweat equity into our business, but at the end of the day, it comes down to how much money does the business actually have. So we end up contractually giving the person from the 2.8 million to, I think we end up agreeing upon 315,000 after assessing like what needed to be done with the business to make them whole to be able to take it over and move forward with the contract. So you can see how important it is to make sure your balance sheet is up to par. So a couple of snapshots I said already is assets are important. So I know if you're a service-based business, you're probably like, well, Charese, I don't have any assets. Well, your computer, your printer, those things are assets. You should be writing those down. And I'll give you a tip as a tax professional, you can write off the depreciation. I know a lot of people miss out on that kind of tax deduction because, again, you just don't know what you don't know. You didn't go to school for accounting like I did. I did the hard work for you. And then, of course, your liabilities. So even anticipating taking loans out and what it would look like to have to pay those liabilities back. And then, of course, what equity you've actually put into the business as well. So again, I've already told you assets are what you owe. So it's very much like cash. It's very liquid, right? And then liabilities are monies that you owe, like a loan. So it's something to consider when you're understanding your balance sheet, especially as a beginner. So we want to make sure that we're on track for our healthy financial health in our business, and we're considering our income, our expenses, and our profits at the end of the day. Knowing your balance sheet is also going to give you a financial statement analysis, which is going to help you understand your company's health, and just knowing the calculations and being able to analyze those numbers. So you always want to stay balanced. And of course, since we're trying to converge these two, and I've kind of gone over the reports that are probably most important for you to make some sound business decisions, I'm going to talk about conversion rates, because it's not just about the money you make. But when I say, well, at least when I say you need to know your numbers, I'm not just talking about the money. I'm talking about how you engage with people on social media. What's your open rate for your email list? How many people are actually buying? How many people are visiting your website, right? I'm talking about all of the numbers. That's what I do as a fractional CFO. The numbers tell me a story, and I want to tell you what that story is. So let's talk about a conversion rate. It's actually the percentage of the visitors who complete the goal. So I'm going to give you an example. I'm going to give you the actual formula, but of course I want to go over like why it's so important for you to know your conversion rate. Is because if you know your conversion rate, you can make money on demand. Yes, you heard me right. You can make money on demand if you know your conversion rate, because we have a cycle of the way people purchase things. We typically say it takes people 5 touches before they buy. So when someone first engages with you, maybe they just see your post, right? They don't actually follow you, they don't like it, they just see you. But the second time, maybe they do like your post. And the third time, they actually comment. Then the fourth time, they visit your website. And the fifth time, they sign up on your email list. And at this point, you've cultivated trust. And now they're like, okay, I actually like you. So send me the information that you have. So we want to always be calculating our customer engagement rates. And it also shows up in how we analyze our sales and our performance data. So the example here is how to understand your conversion rate is your total visitors time 100. So the example here I'm going to say is, let's say you post something on social media. You get 100 comments, but you get 1,000 views. I know we always get frustrated with that. We're like, 1,000 people looked at this post, but only 100 people commented. Now, there's norms on social media, right? Like, what's the expectation of how many people? So if you had 100 comments with 1,000 views on one post, that means that you have a 10% conversion rate. So now as you make this number bigger, right, and you're connecting it to making money, and if you're consistent across your brand that your conversion rate is 10%, you should be able to actually send an email. Let's say you send an email, you have 1,000 people on your email list, and 100 people buy your item. So now you still have that 10% conversion rate, right? So that's what I mean when I say you can make money on demand. So now when I do big numbers, let's say we start dwindling the number. If you say I need to get in front of 10,000 people on a daily basis and my conversion rate is 10%, I'm trying to sell an item, and we're talking about this 5-point touch that we talked about earlier, you could actually go back and say, okay, if I post something, then I'm going to get 1,000, so it's 1,000 likes, I'm going to get 100 comments. And if I get 100 comments, 10% of those people, 10% of that, which is 10, is going to sign up for my email list. And then out of the email list, if I send something that I'm selling something, then 10% of the 10 is actually going to buy. And let's say your item's $10 and that one, remember, because we're down to 10 people, one. So that means like if I get in front of 1,000 people and I make a 10% sale from the point of touch, now I know that I need to get in front of 10,000 people if my goal is to make $100. So you see how you're connecting the dots with your conversion rate and then the analytics of your numbers, of your points and touches. And then now you can actually start doing ad pays on the back end. So now you're saying to yourself, if I spend $100, this ad is going to get in front of 10,000 people. And now you should know on the back end, because you have consistent records and data and information, right, from your research and development. So you know if you ran an ad for $1,000 for Black Friday, that you should make X amount of dollars because you know your conversion rate. So now like connecting the dots is so important in your business. And I'm not saying like there's a science to it. I think once you figure out, I think some people are like, oh, what's the sweet spot or what's the secret? There actually isn't a secret. You have to figure out what that is. But once you figure it out, you can rinse, recycle, repeat. I promise you, you can rinse, recycle, repeat. I show people how to do this. So we figure out, so it's like tweaking. Sometimes you go on someone's website and instead of saying buy now, say explore more or get more information, right? Sometimes it's a lot of times with business, it's not even really the numbers game you're playing. It's actually the psychology of how consumers buy items. I noticed that I changed just a simple word on my website not too long ago, and my visits to my website increased like 25% just by changing one simple word instead of saying discovery call, get to know me. I think that's what the words I changed it to, and it just blew my mind. Like just changing the little things, because the thought process is I want to be inviting, right? Instead of making people feel like, oh, like if I do a discovery call, then maybe I'm committing to something, or she's going to ask me for money. And really, the thought process is I'm trying to see as much as you want to work with me, that I'm a match for you to work, that I'm to work with you. Because just because someone does a discovery call does not automatically mean that we're going to sign a contract and that we're going to be a good fit together. Just a thought process. So always stay curious. I say look at your I'm it might be a little OD, but I say looking at your numbers at least once a week, just to see where it's at. And I actually have a really good tool to help you do that. So ultimately, to fit, to make sure your financial management gets you on the line to success is building your financial foundations, right? Customizing your chart of accounts so that you can have an accurate profit and loss sheet that tells you a story. Knowing what your balance sheet is, so that means reconciling your accounts at each month and being able to know the health and how much your business is worth at every step of the way. And then your strategic financial planning is constantly going over your numbers and seeing what your analytics are, what the numbers are doing, and then making sure that you're seeing things through. I think as entrepreneurs, a lot of times we have an idea. So the thought process is, okay, I've been telling my academy class that we're doing our Black Friday sales. Well, it's in May. We've been talking about Black Friday since first quarter, to be honest with you, because I think what happens is we're like, usually what happens is, let's see, we're in May. So let's say people won't start thinking about Black Friday until the 1st of November. Well, that's a little too late. You kind of have to warm up, because if we're doing the 5 point touch like we talked about earlier, you might miss out on money, because by the time someone actually you put out your Black Friday sale, they're probably only in phase 2 or 3 with you in relationship and earning trust, right? Trust is built on the level of exchange and time is not on your side if you decide to run an ad less than 30 days before the day you want to run your ad. I'd say any Black Friday sales, you really should probably be hyping people up at least 60, maybe even 90 days. Listen, I ain't gonna hold you, to build up that rapport, so that when the time comes for you to pull the trigger on selling the item or your products, people are ready to spend their money with you because they feel like they trust you, they know you, they have a rapport with you, right? They've been liking your content, they've been engaging, they've been commenting, they might even slid in your DMs and ask you a couple questions. That's the setup. That's the return on investment. And then lastly, maximizing your financial resources. So we want to make sure that we're optimizing our financial decisions and our business performances, and just thinking through long term, and then also making sure we're making KPIs, which are key performance indicators. So a lot of times also, even though you've done tax, let's say you're an elite employee, you are A plus in your business, right? It does you no good if you don't go back on the strategy. So even me presenting to you, maybe you're like, oh well, Charese, I know my P&L and I stay on top of my balance sheet and I make marketing strategies. And matter of fact, I've already made a Black Friday sale. Well, the thought process is, have you gone back to the North Star, your goal, and then actually assessed, are you actually hitting your target? So a lot of times people come to me and say, oh, Charisse, I want to make 6 figures. Love that for you. That means roughly you need to make $333 every day, right? Then when we start implementing that, if we go back even now, let's say Q1, and you haven't hit your goals, then it's time for you to pivot. Maybe you need to change the wording on your marketing. Maybe you need to refresh it. Maybe you need to run a new campaign. Maybe, I don't know, it could be a multitude of things. But if you don't go back and course correct, by the time December gets here, it's too late. It's too late. So the thought process is, if you can't course correct, and if you're true desire is to make six figures, it is always uh, at the forefront of your thought as an entrepreneur to be course correcting in real time. If you continue to do things and it does not work, then you need to pivot. I always tell people not to fall in love with the goal, but fall in love with the process as you're going through it in entrepreneurship. So some of the milestones, right, to keep this trajectory is understanding your financials. I'm gonna nail that in the ground for you. So not only creating your profit and loss sheet, but budgeting your money as you spend it. Especially I find this amongst service-based businesses. It's easy to spend money because you make so much money very quickly and you have low overhead costs. But again, very much like I told you earlier, when I reassessed my profit and loss sheet, it was like, oh, I can use this one app to do three of the things that I'm using separately and save $250. Would you rather save $250 in your profit and loss sheet, or do you want to spend it? Yeah, that's what I thought. So then you create your financial plan. So sticking and tailoring those needs to what your business needs. So maybe as we're thinking, okay, we talked about return on investment, but the other part is, let's say I want to buy a new computer. So that means putting money aside. Or we can take it a step further. We talked about understanding your ebbs and flow of your cash flow, right? It's tax season for me. These last 4 months, that's when it's the Super Bowl of my business, right? So I put 25% of that money away for the end of the year when it starts getting a little bit quieter. Even though I have a couple of clients who like want to do tax planning sessions, or I have coaching clients that want to meet with me, it's a one-off. So it's not like consistent income. So the thought process is, when you have your ebbs and flows, if you're a retail store, if you're an ice cream shop, if you're, again, you can fill in the blank wherever you want to, you need to be very clear about the times when your business is not doing the Super Bowl time. I mean, let's say, even if you're in a seasonal business, right? Let's say you're a lawn care person. You're not cutting grass during the winter months. And most time, what lawn care people do is they move snow during the winter months to supplement that. But we can't predict if it's going to snow or not. So you need to make sure that you have some steady money to keep you afloat during the times when you're not having so much cash inflow. The other thing is having effective systems, obviously exploring the things that you already utilize. QuickBooks I love, and Wave, because it breaks down the percentage of how much money you're spending in the revenues. And then it also kind of helps you with the projections, so things that you're anticipating coming. So let's say that you bought a piece of equipment, it could tell you like when you're going to finish paying that loan off, right? Or vice versa. So it's so making sure you're utilizing the tools that are already available to you, and a lot of things that we already use, software systems, does the heavy lifting for you. You just need to kind of explore that and look into it more. And then monitoring the performance. Again, those key performance indicators. If you're not keeping track of if you're on trajectory for your revenues or even your expenses, you can find very quickly that you're going to be losing money. And then, I mean, we know what happens if you continue to take a loss in your business. And then scaling. So thinking of the return on investment. I think a lot of clients, what happens is that they go for funding, right? You want to spend money on something. This is where that return on investment is key, because when you don't assess if this thing is billable or not, or if it's going to make revenue for you or not, you can find yourself losing money thinking it's a thing that's going to scale your business. So example, when I first started my business and started getting some income, I hired an assistant. The assistant was fine, but when I think of it in retrospect, the assistant actually didn't make money for me. The assistant took activities off of my plate so that I could do other things. But if I'm not being responsible and doing activity that's going to make money for me, I'm actually losing money paying the assistant to do things that I need, but I'm not being proactive or optimizing my time as the entrepreneur in making more money. But let's flip the thought process too. During tax season, I do a food service. And this is the other part. I want you guys to be very clear about who you are as an entrepreneur. I have a whole journal about it, but it's clear because what will happen is you'll start realizing like, oh, if I use a food service, then actually I can make more money. That was my thought process. And what I mean by that is how much money I charge people to do their taxes. If I get someone to make my meals for me, I don't now have to make a grocery list, get in my car, get said groceries, bring the groceries back home, cook the groceries, and still have to wash dishes. I could have done 2 tax returns in all that time and made more money instead of the food service. So again, assessing your return on an investment sometimes will help you scale your business in a way. So a lot of people come to me and say, "Oh, Charese, when should I hire a bookkeeper, or when should I apply for your services, or an attorney, or any kind of specialty?" My thought process is let's assess the return on investment. How long does it take you to do your bookkeeping? 40 hours a month. Well, I can give you 40 hours back on your entrepreneur schedule. This is my rate. And then you consider what your hourly rate is, like how much your business is paying for you. Hands down, hiring a bookkeeper is always going to give a return on investment for what their services are going to provide for you. And of course, a fractional CFO like myself, giving you the analytics and actually having a conversation with you of what your numbers are doing, chef's kiss. It's going to line up every time. So, of course, budgeting, your burn rate, and your reporting. Those are the things that you need to have at your forefront at all times. I mean, I think we're just reiterating the things that I've been talking about is knowing your numbers, how you're spending those numbers, and then analyzing those numbers in order to make sound decisions in your business. And then just another slide to say it again for you. So I'm sure after this presentation, you're like, Charese, how can I keep in contact with you? Glad you asked. And of course, I just want to reiterate that I'm Charese. I'm a fractional CFO. I'm basically a human calculator. I went to school for accounting. I've always loved numbers. Numbers always love me. 1 + 1 is always going to equal 2, no matter what language it's in. And that's just how my brain thinks. Of course, I have some freebies for you on my website. If you scroll down about 3/4 of the way, there's an area where I have a ton of freebies that have been collecting over the last 2 years to help you in your business. Simple as 75 top write-offs to how to read your P&L and so on and so forth. And then I have a podcast called Business After Dark. She is almost 5 years old, and it's the thought process of what I've experienced and learned over the last 18 years in business. These are the QR codes for those things if you want to stay connected with me. Of course, my Instagram, Financial Fancy CFO. And then, of course, the podcast and my email. And then lastly, I have a link for you of all of my favorite resources that I love to use in my business. I want you guys to utilize them and just look to see if maybe you might be able to combine those costs that we talked about earlier into one to help you kind of consolidate your expenses in your business, because we all know we're bootstrapping it here. So we just want to make sure that we're making sound decisions and that we're doing things that give us a return on investment and help us to make profits in our business. I hope this presentation kind of helped you figure out what you could optimize more, maybe something that you're not utilizing all the way, or maybe just kind of help you reset to be like, okay, I make goals, but I actually don't see them through, or I make goals, but I don't make key performance indicators, so I don't actually assess how the business is doing performance wise, week after week, month after month, or quarter after quarter. And we really just need to do better than that. It's not that I think that entrepreneurs aren't equipped to make the money. I have yet to meet an entrepreneur who does not know how to make money. It's really the management of the money. And of course, I'd love to come back and give you guys another presentation on more strategy around taxes and things of that nature. But for now, I think I've given you enough, and I hope that you guys have a great day on purpose. I'll talk to you later. Bye.